wanted to tell you guys about some things that I've been doing here lately. You know, with all these flipping of properties, they're killing me. I'm just so done with wholesalers, and I'm sure you guys have seen my emails here lately. Absolutely crazy. I've actually, for the last 2.5 days, have been, you know how you have those days where it's either all wholesaling or all regular real estate. The last 2.5 days have been law for me. I'm trying to hold people's feet to the fire. I actually had a lawyer call me yesterday from a title company, and he didn't know how to close a deal. And because what we were doing was we were selling the LLC. He had never done it, never heard of it. And so I had to teach him, I had to walk him through this whole settlement, and I wasn't even part of the deal. I wasn't getting nothing out of it. So it's been really, really crazy. But, so I went, I guess it's been about 1.5 months ago, I went through note school for Eddie Speed. And I learned a lot of stuff there. It's amazing the stuff that you can do with notes. The money that you make, it's astronomical compared to what you can make off of a rehab. So I wanted to bring Dan and Sid in. They really know their stuff. Dan has been doing this for a while. He is so analytical, I can't stand it. It's the engineer in him. So he picks things apart completely. And he's amazing. So I'm just going to hand over the floor to these two. This is Dan and Sid.
How you guys doing?
Okay. So again, appreciate y'all coming here tonight. Thanks for your time. And now we know, because there's a huge RIA meeting going on about 2 miles from here, we know we got the quality and all the quantities over there.
Yep.
So we're good to go. And for the people who really want to know the stuff, we're right here. Happy to have you. So let me talk a little bit about the Real Estate Investment Solutions Group. We're actually newly formed this year. If anybody could, we're videotaping here. We're going to turn this into some stuff for our website. If everybody could please put their things on silent. Not even buzz. I prefer it silent if you could. So while you're doing that, I'll start over. So again, Real Estate Investment Solutions Group. Sid and I actually started this just this year. Sid's been looking at notes for a long time. I'm doing it for just a little bit less. But our tagline here, Reperforming America with Smart Investments. This whole non-performing note thing is kind of the answer, or part of the answers to this 2008 mortgage crisis. And there's still a huge mess out there. We'll talk some numbers on that later. And there's still a lot of people having problems, and the banks either have been unwilling or unable to take care of it, and it kind of flows downhill. And as small investors here, you know, how many rehabbers are here? Right, got a good bit of rehabbers. How many wholesalers? Right, so all these problems created. I mean, you know, how many rehabbed a vacant house that's been foreclosed on? That is, you know, right? So how many short sales have you done, you know, out of this? So there's a big mess to clean up that societally, you know, we are a part of. As rehabbers, rehabbing a vacant house is a benefit to the community. You know, helping somebody get out of a situation is a benefit to them and the community. So helping people through non-performing notes, it's a good thing. I mean, and doing good while doing well, or doing well by doing good, that's something that, you know, we're all a part of here in one way or another. And another aspect that a lot of people don't really understand, but it's related, and you'll see how it's related, where what we're doing actually connects to what you're doing, and vice versa. We all need each other in this. And so we're all reperforming America through smart investments. We're all smart on how we do our rehabs. We're all smart in how we acquire property and hold it for rentals, etc. But we want to show you the power of notes, the versatility of notes, and how you really can make money, and how, in our opinion, that it's a superior investment as an investment strategy overall in a number of ways. So with that said,
We're going to just take a minute just to give you a little background of who, you know, Dan's background, my background. So we can start from there. I'm Sid Hameed. You guys, some of you guys know me here. But I've been a rehabber in real estate since 1990. I've done hundreds of transactions, I've built homes, rehabbed homes, also in the real estate brokerage called Expert Real Estate Advisors Group. And so we're out in Bowie, Maryland. So I got into the note business about 4 years ago, started to learn about it, read about it. But then I really dove in early part of this year. And so in terms of graduating, the note business is where you really want to be because you want to be the bank. And if you guys can be the bank, then that's where the real money is. So in the amount of time it was taking to rehab a house and to actually sell it, go through the process to make $100,000 or $80,000, I mean, I could do that doing the note business in less time because we're buying multiple notes, not just one particular house at a time. So the risk is diverse. So if you guys are rehabbers and you really want to take your game to the next level, I mean, this is where you guys need to be at. So.
Yeah, the timelines may be a little bit longer for notes in some ways, but the dollar price points and the quantity kind of makes up for that. And once you fill a pipeline, and it's hard to fill a pipeline with rehabs too much because you got to hold a lot of expensive property. It's a little bit different game. You'll see how it's different. You know, just got to put on. You got to change your mindset a little bit. And we'll talk a lot about mindset here. I'll show you my point of view of mindset. Hope I don't tweak anybody up when I do. So once you go start us off here. So we have an investment group, and of course we bring in investors. We work with joint venture investors, and I'm not going to give you a pitch right now, but just up front, you know, we present value to our investors, our knowledge to execute, and to be adaptable. It's a great thing about notes is that there's a lot of different ways you can make money off of notes, so you have to be adaptable as well, and you don't want to get too myopic or too tunnel vision on any one thing. Our relationships with hedge funds, we've spent a lot of time building relationships, and everybody knows real estate is a relationship-based business. This is no different. You got to have the right kinds of relationships with the right people. So, and key mentorships, people we've learned from. Everybody in real estate investing has a mentor or multiple mentors in some ways, and that's been very meaningful to us and has helped us be successful. So what we're going to do tonight, try to follow this, and I know it's going to get hot in here, so we're going to try to keep going through these. And so we're going to talk about some basic terms and mechanics of notes. Why would you want to invest in a note, or really more specifically in what we're doing is non-performing notes, okay? Why would I want that? Finding and buying notes, we're going to touch on that some. And then working notes and exit strategies shows you some examples of things. That should pretty much fill the whole time. I know that there's a lot of new terminology here. There is a lot of just new concepts. And we're going to have to hold questions though, because I think, you know, if we start getting into a lot of questions, we'll just go way off track and then we won't get through this. So try to hold your questions, write your question down. If it's really, really burning, just go ahead, we'll give it a go. But try to save the questions for the end, and then we'll work through some of those as best we can. Okay, is that all right with everybody? Okay, so I'm going to try to engage some of you guys. So when I ask you to do something, say something, or ask a question, you know, we're going to try to keep you guys awake too, because at the same time, Jamie is saying how analytical I am. It can be a very dry topic, and there's going to be a couple points we're going to throw a whole bunch of data at you at one time with a spreadsheet or something, and we're going to try to keep you awake and engaged a little bit in the meantime. So how notes work? It's simple. Buy low, get cash. How non-performing notes work, really. Buy low, get cash. Sell high, more cash. Okay, LOL, right? But that's, in essence, this is the way you do it. This is how it works. So one thing you got to know: you're buying secured debt. They may not be paying on that debt, but you're buying secured debt. This is a very important concept. It is the main concept of this whole thing. So go ahead. Not the property. You're not buying the property. I don't care how many people have asked me, oh, well, when I get this, you know, I have the property. No, you don't. Okay, so you're basically now the bank. You bought debt. You own debt. You are now, in essence, the bank. You're not a bank, you're not licensed to be a bank, but you're a bank. You own the debt, and somebody owes you the debt, you're going to collect on that debt one way or the other. If you don't, got the investment thing wrong. Okay. So what is a note versus a mortgage? Okay, that's the next big question. Like, other than what is a note, right? Go ahead, Jane. So a note is a promise to pay. So go ahead, one more. I don't know how everybody can see this. A note, I stole this from the internet, blatant steal, so, sue me. It's a promise to repay the debt. It's an IOU. A note is an IOU. It's a negotiable instrument, though. I can sell that note. It's a piece of paper. How many wholesalers are here? Okay, how many have bought from a wholesaler here? Right, you know that that wholesaler locks up a contract, and that contract now has value. Basically, a note is that contract to pay, and that note has value. So I can sell that note, I can buy that note. If it's a broken note, a non-performing note, it isn't worth as much as a performing note. And we'll talk a little bit how to value those and how you understand what the real valuations are, what a value of a note is. Good. So what's a mortgage? Mortgage is a lien, and it gets filed in the land records, so that makes it official. It's officially at the county, and if you have a mortgage that's not filed, you have a note on it, well, nobody knows about it. It's only just between you and that person, right? You don't have the sheriff to help back it up. It's an enforcement mechanism that gives you the right to take away the collateral, in this case, a house, if it's not paid. So you have your note, which is the promise to pay, that defines the terms and agreements, and you have the mortgage, which is, combined with the note, the ability that collateralizes the property so you can take it. So what is a note? Note's an IOU. It has a negotiable instrument, underlying collateral, versus a mortgage, a lien that enforces the right to the collateral. Has everybody got that? Okay, so good. So how does it kind of work? So how is a note owned versus a mortgage? That IOU can change hands. So it's like, well, everybody heard about the whole robo-signing thing, and where's my note, where's my mortgage, who has it, and I'm being foreclosed on, but you can't prove that you have this note. Everybody heard about all that?
60 minutes?
60 minutes. So basically there's a chain, the IOU chain, the note chain, it's held together by a series of documents called allonges or endorsements, which is sort of like a stamp on the note itself. And it's completed as part of the sale, it's held in collateral files, so that doesn't get formally recorded at the courthouse or anything. The mortgage and assignment chain, the mortgage is the lien, and that chain goes, and there's multiple assignments of mortgage, went from A, went to B, went from Wells Fargo Bank to Bank of America, went from Bank of America to REISG. I wish we could buy directly from Bank of America, that'd be awesome. But anyway. And so, go back. That's recorded. That's recorded at the courthouse, and we'll say what book and page that book is in when you see that recorded. If you have a mortgage and it isn't stamped with how it's recorded and the price on it, you don't have a recorded mortgage. It's probably recorded, you just got to go get a copy of that recorded thing. So that's one thing to look for in your collateral files. We'll talk a little bit about some of that later. Go ahead. So how notes work? The main keys to success for notes, in my opinion, low purchase price. Got to get it at the right price, just like anything, right? Good valuation. You got to value these. Understand what the value of the underlying asset is. Value of the note itself. Is it 6% over how many years? So you need to understand how long it's been paid for, what the unpaid balance is. Good risk identification. What's the risk of the property? Risk in the collateral file. You gaze into that collateral file and try to see the forest for the trees. It's, try to pick out things that might spell risk on that. And I'll talk a little about some of those later actually. Multiple exit strategies. That's another key to success. So how many exit strategies are there for a wholesaler? One, right? Okay, how many exit strategies are for somebody who buys stock? One, they gotta sell it. How many exit strategies for a rehabber? A couple, three, right? Okay, and we'll compare some of those notes. But you have a lot more exit strategies with notes. That makes this in my opinion, again, a much better method of investment. And investment is a key term. So, and execution on all of the above. That's where Sid and I come in. So the main keys to success are also plus a change in mindset. So here's my little prop here. I just dreamt this up last night. This, hope I don't tweak anybody up here. No, not disparaging anybody's way of life. This is my rehabber mindset, my rehabber point of view. I'm local. I'm not going to go too far from my house. I'm not going to go, certainly out of my metropolitan area, because I can't, the economics of it. So I'm looking this way. This is my rehabber point of view, my rehabber mindset, my rehabber sphere of influence. I can't sell my local house to somebody from California very easily unless they're moving here. Now this is my note investor and general investor, real estate investor point of view. I broaden it out and I'm looking at this more like binoculars. I get a broader point of view. Of course, I'm in real estate. I'm not looking local anymore. I may be looking around the country and I'm looking for assets to invest in. So this is my local, and it may still be also, I got to have a rental in my backyard. I don't want to go farther than 20 minutes from my house. Versus, okay, I'm willing to own a rental in Indiana or someplace like that, as long as it's say a turnkey property. And I actually own a couple of those, and I think I'm going to convert that to cash and buy those.
Also, the mindset, just to touch on this, I mean, look, a lot of us are uncomfortable in terms of leaving our local areas. And even with me, it took me a long time to get over this, because I wanted to get out and touch it and feel it and look at it and analyze it and, look at everything to determine, am I going to really make money on this? And, doing this for so many years, it took me, a long time to realize that I could go out into Florida, into Georgia, North Carolina, South Carolina, buy these assets for 20 to 40 cents on the dollar. And I could still find contractors and property management companies, other people out there to do that kind of work. And in DC, Maryland, Virginia, right now, supply is tight. It's very tight. There's a lot of money floating around here, but there's no assets to be bought. Right? So you guys have to change your mindset. It's scary, but it's possible and it can be done. And it took me a while to get over that. But once you do it and you see the potential, you see the opportunities out there, I mean, it makes total sense.
So, changing your mindset. Take the position of the bank. Okay? You are be the bank. Next. Chevy Chase from Caddyshack. Okay, be the ball, Danny. Be the ball. Okay, my name's Dan, so he's speaking to me. I wanted to do a video with a voiceover of him doing that and say be the bank instead, but didn't get it. So, everybody wants you to repeat after me. Go ahead. Go ahead.
Enter.
Be the bank.
Be the bank.
Be the bank.
Yeah,
Got
be
it?
the
Be
bank.
the bank. Okay. Okay, next. Okay, so let's talk about how notes work. Okay, so we have an asset. It's a house,
And it could be anywhere.
it could be anywhere.
Yeah.
It could be anywhere. Right now, it's just on this screen. Go ahead. The debt is $100,000 unpaid principal balance. UPB is unpaid principal balance. This is the proverbial, start with 100,000 because it's easy numbers to work with. Okay, so that doesn't include necessarily back payments, penalties, all this other stuff. Right now, it's what they still owe on their mortgage, on the original mortgage debt that they're paying down. Unpaid principal balance, $100,000. Go ahead. The bank, BPO, broker price opinion, the bank says this asset, the underlying asset, the collateral for that note, is $60,000. Okay? Go ahead. So, from the bank's point of view, they're underwater 40K. Anybody think this is outlandish? Right? No? Okay, all good? Now, what the bank is asking for that nowadays is a little bit higher than it was recently. Everybody heard about, oh, you can buy 20 cents on the dollar, whatever. No, it's going up. A lot of people getting interested, hedge funds buying stuff up, it's all kinds of craziness, so it is going up a little bit. There's still value here, still value to be found. We'll show you a little bit more. So you might be paying 55 cents on that BPO, which is 33% of unpaid balance. Still not a bad price, right? How many are paying 50 cents on the dollar or 55 cents on the dollar at auction? Anybody, any auction buyers here?
Yep.
Yeah.
Okay, are you paying 50 cents on the dollar?
Oh, no.
How much you paying?
Way more.
How much you paying?
I've seen some people do 90.
Right, 90 cents on the dollar of what dollar, right? The market value of that?
Market value.
Okay, so rising markets help mitigate this, don't they? Okay, keep going. So the actual value may be $70,000. Okay, is that craziness or does it sound right? Could be, a rising market. So actual underwater is 30K. I still pay this, so now I'm at 47% of BPO and still 33% of UPB. So I'm targeting to be less than 50% of fair market value if I can. In a rising market, I might not care about that so much. Florida's really hot right now. Atlanta's pretty hot. Texas, Dallas. I got a story about one in Houston that I'm personally involved with. And so anyway, go. So what we do once we get this, we've paid this, we're going to go through several different exit strategies. And these are just some examples right now. To reperform that note, we might do a short sale. We can do a foreclosure sale, a little more expensive. A REO sale if no one buys it at foreclosure. And rehab. The main thing is that I'm in control of every step of that as much as can be. Whereas once I sold at that foreclosure sale, who's your guys my buyer, right? I'm behind the lawyer. I'm the one virtually standing behind that lawyer that's there taking your bid. And I'm only selling it if you paid my price.
There's a reserve.
Right? If you didn't meet my price, no sale. Then I get to go do something else with it. Okay, so let's reiterate. Bank thought it was worth 60. I figured out it was worth 70. So I'm willing to pay what they're asking for because I know it's good value. Right? So due diligence, due diligence, due diligence. Like the 3 L's in real estate, it's the 3 D's. Okay? Go ahead. So some quick FAQs. Do I own the property? No. Okay. No. No, you only own the debt and the lien. Right? Okay, next. Can I foreclose and take the property, rehab it, and get really, really, really rich?
Yeah.
But you get richer if you do it the other way. So go ahead. Not all at once. You must follow the local laws. Okay? You got to go through the foreclosure process. You can't just go bust it in there and go, my house now, get out of here. Here's the note, you know. So, anyway. Why would I want a non-performing note anyway? They're not paying. Why would I want to buy something that somebody isn't paying on? Okay? I don't know. Why would you want a broken house? So tell me, why would you buy a rundown house? You already know the answer. Lynn, why would you buy a rundown house?
Well, to do rehabbing and try to resell it again.
You're going to add value, right? And then sell it for more money.
Right.
How hard are you guys going to work to add value to that house? How much time are you going to put in? Dale, how many rehabs have you done?
Quite a few.
Quite a few. How hard you work on each one? How many hours you put on one rehab?
Always takes longer than you want, costs more than you thought.
How many hours you put in on one rehab? Give me an answer.
Personally, maybe 30, 40 hours.
34, just on you?
Yeah.
Okay. So who's doing more hands-on rehab, smashing their thumb, whatever, right?
I had one that took 9 months.
9 months,
Literally,
okay.
like, every
A lot of
day.
frustration. How many different people you got to deal with? Electrician, plumber, all those things, right? Sid, you've done a couple of rehabs, right? Yeah, okay. Gary, right? So why would you want a broken house? You're going to add value, you're going to sell it for more? Perfect. I can do the same thing with a note, a non-performing note. Okay. So basically we're going to control the asset for a deeply discounted price. We're the ones in control, okay? Profit from that control in many ways, not just 2 or 3 ways. And we're going to do it without the burden and overhead cost of ownership. When you're rehabbing that house, most of you, unless you're really good at creative finance, you're owning that sucker, right? Most of the people, you're doing a rehab, you own that house until you sell it. You know, dicey position to be in maybe, especially if you find out it's cracked foundation. So repeat after me. B.
B.
The.
The.
Bank.
Bank.
One more. Everybody, all again.
Be the bank.
Right, be the bank. Okay, so let's talk a little bit how the bank makes money and how we're going to be the bank just a little bit more. How's the bank make money? Anybody know?
Interest.
Interest rate
Interest rate on what?
on your money that you borrow.
Principal.
On loan. Okay, so they make loans and they get interest on them. So when they make a 6% interest rate loan, how much money are they making on that?
Depends on how many.
Okay, so a $100,000 loan, how much are they making on their $100,000?
$6,000.
Six, okay. Do they have $100,000 to loan you? Are they loaning you $100,000?
No.
No, they're actually not. What?
Well, not learning anything.
Well, they're loaning some money. They have to have some money to loan, right?
Right.
Okay. But anyway, so let's go. Amortization, they're getting paid up front on a fractional reserve. So they're getting paid, everybody knows about amortization, I think most people here, right? If you don't, go look it up, that's homework. Fractional reserve, that's more homework. Banks only need 3% of what they're loaning, right? They actually only loan that $100,000 loan, they only had to have $3,000 in the bank. to
That's
loan
why
on
be
that.
the bank.
Be the bank, right. Well, I don't have the US government, the Federal Reserve, or whatever national bank or whatever country helping me out, so I don't have that. But another way banks turn over and they refi every 7 to 10 years. So that's great. So go do a little math, go do an amortization schedule, and then figure out if you weren't loaning $100,000, you're loaning $3,000, and how much money you'd make if somebody refis after 7 years. It's a lot.
Yeah.
My math, I may not be right, I'm not an accountant. Oh, I forgot the disclaimer up front, not lawyers, not accountants. None of this you take, should be taken as investment advice or legal advice, okay? Right? Okay,
Disclaimer.
right. When we do the video, that goes on overlay on front, right, Sean? Okay, so go ahead. So with NPNs, you take the position of the bank at a deep discount, go ahead. And by doing the work out of the loan, you're getting paid up front while improving your position by as much as 75%. How many rehabbers here do you actually are improving your position by that much on a rehab?
Not many.
And how much you spending to do it? Okay, so if you bought a $200,000 house and made it into a $350,000 house, how much money would it take you to make that transformation? And then how much does it cost you to sell that house and get out of it, and how long does it take you to do it? Listen on, my friends. So selling this loan will yield, okay, this is a hypothetical loan, 82% return on investment. Try that on for size for rehab. Okay, we'll go through some examples. This is not outlandish. That's a good one, but
Yeah, but also now, this 82%, think about how much time have you put into this? Time value of money, right? If you look at the time value of money formula, and you look at how much time you put into doing a rehab, and all this nonsense you have to go through doing a rehab, and you make 82% on this, and you're putting in less than 12, 15 hours, if that. Because you got the attorneys, and you got the cloud companies doing most of the work.
okay. B,
Be the bank.
okay, everybody, again?
Be the
All
bank.
right, you got to keep you woken up. I'm seeing some people, you know, they're tired from the commute, didn't get home for dinner from work, and so just trying to keep everybody awake. All right, so why notes now? Why is this a good time to do notes? Market opportunities projected good for years. When was the meltdown? 2008, okay? What happened after 2008? A whole lot of people got what? Loan mods.
2009.
2009 got loan mods. How many years ago was that?
5 years.
Okay? Don't have to take your shoes off for that one. Okay? Now, those loan mods, almost all of them came with what? It was a variable,
Balloons.
a balloon,
Temporary.
a balloon, temporary is an interest rate. What's happening now in the next year to 2 years? All those loan mods that took place in 2008 to 2010 are coming due. There's going to be another spate of these, not as bad. It's going to be another little bump though. Okay? It's a protected investment. We already established it, right? You have right to foreclose. There's collateral on that note. We're going to control that asset with reduced risk. It's less risky. I mean, it just is. It's profitable. Trust me, and you'll see the numbers. Okay? It's scalable. Doing it all yourself, how many rehabs can you do at one time? A couple. I mean, even just managing a rehab company, like Dale can do probably, 16 of them at one time, but how many can you do at one time, Gary? 4 to 8, okay? How many rentals, if you were doing your own rental company, managing your own rentals, how many rentals could you do at one time? Okay, so let me ask you this, we had any buy and hold people here? Okay, what's a good return on investment for you? What do you think a really good return on investment for a buy and hold is? For a
For your yield.
townhouse rental or whatever, your yield?
12%.
12%? Okay, and that's really good. But what do you think your average is? What?
8.
8, okay, 8%, and what happens when the furnace goes out? Who are they calling? You. Okay, so when my furnace goes out, do I call Bank of America? Actually, it'd be Pentagon Federal Credit Union, but, no, I do not, and I doubt you do either. Okay, so it's versatile, there are many exits and many options, right? How many exits does a rehabber have? Not nearly as many. Why notes now, again? Between 7 and 10 million delinquent mortgages and more coming. Actually, this is supposed to be one slide up. Got the order wrong. No, right. Nothing you can do. Okay, so I've heard this number recently, less than 400,000 RIO assets available nationwide. Anybody realizing the RIO market's kind of drying up here? Aren't that many out there? Been a lot harder to come by. Banks have made a move from selling RIOs to selling paper. 75% of the hardest hit funds are still untapped. Hardest hit funds is part of that TARP program. The states are sitting on them. Some of the states have actually closed down their program. I'm sure I know what that's all about, follow the money. But however, they're still there and it's still you're able to take advantage of it. We'll talk a little bit about that, how that affects your return on investment. So go ahead. A year ago, Washington Post, there's 10.7 million U.S. homeowners who owed at least 25% more on their mortgages in their homes were worth at the beginning of September 2013. So yeah, it's still going on. I know this was a year ago, but does anybody really think much has changed in a year? Not too much. It went up a little bit, but we also know there's more foreclosures coming. So go ahead. So let's do the parallel universe, comparing notes to physical real estate. Okay? Go ahead. So physical real estate exits. Anybody have anything to add to these? We got a wholesale, flip, rehab, retail sale. If that doesn't work, I might lease option it. Kind of a wholesale variation on that is find somebody who wants to sell their house and then work this lease option thing. Can owner finance it, I can rent it, I can live in it if I had to, right? Anybody to add to that? Anything? Does this list get significantly longer? Most of these, the predominant ones are probably what, a third of that list, right? No more than half. So that's your exits in physical real estate. So the farther you go down that list, the cost and risk go where? Farther down that list. Up, up. Anybody? Okay. Anybody disagree with that? Okay. You guys are agreeable people. Very good. Here's the note exits. Okay. I can wholesale a note. I can flip a note. I can reperform a note. That's the preferred method. There's several things I would do after I reperform that note. Just like after I rehab a house, I can do different things with it. I can sell it. I can keep it for cash flow. I can do a partial sale. Jamie wanted me to mention that specifically. I can actually sell, it's like a lease option on it. I can sell the interest, that amortization up front, that cash flow has value to somebody. I can sell it and then get it back later on. Really cool. I can do a short sale because I'm in control. I can tell them I can allow them to sell it if they want. If they don't want to sell it, I can foreclose and do a foreclosure sale. If they don't want to go through foreclosure or would like to avoid it, they can give me a deed in lieu. I may or may not want to do that. I can choose. Because if I get a deed in lieu, then I own what? What do I have on me now? I have the liens on the property that I am now responsible for. If I foreclose, I wipe those out. I am the one in control here. And this will bend to my will.